Joining me right now is the Odeon Capital Group Chief Financial Strategist, Dick Bove, and the People's United Advisors Chief Investment Officer, John Traynor. Also joining the conversation all morning long, Fox Business's Dagan McDowell and Forbes Media Chairman and former Republican presidential candidate, Steve Forbes. Great to see everybody this morning. Thank you so much for being here. John, kicking it off with you, your thoughts on this market here with the volatility and upset for the NASDAQ. What's your take on the future?
Well, I think what you're seeing is just a massive dose of portfolio repositioning. I think, you're seeing what we saw was a shift from the growth to value, but it's just increasing that cyclical exposure in client portfolios. That's flowing through the equity market. It's also impacting the bond market. So it's just this portfolio repositioning. We think we're advising clients that it's going to continue, but you want to be positioned for a growing economy. You want to get that exposure to cyclicals, and that's how we're advising clients they should be invested in this area.
And Dick Bove, I love what's happening with the banks. You look at the XLE index, you're talking about a gain of 40% for some of these banks over the last year, partly because yields have been rising. Treasury yields are once again rising this morning ahead of the February CPI. The House is expected to pass that $1.9 trillion stimulus plan today, all pretty conducive for an economic growth story going forward. Is that what has been boosting the banks? What's your take on the sector?
Well, I think you're right that the likelihood of some input from the government to stimulate economic growth in the second half has certainly got the banks going. But what really has them going the most is the money supply of the United States right now is growing at 26% year over year. That's never happened before, ever. And the fact is that 80% of that money comes to the banks. So the banks are sitting with literally trillions of dollars in cash and short-term securities on which they're earning a very, very low amount. For example, JP Morgan is earning 4 basis points on $500 billion that it has on deposit with the Fed. If the economy gets stronger, and if JP Morgan can move that money out of the Fed and into the economy, it'll earn 400 basis points on that money. Therefore, the likelihood of a significant increase in bank earnings is huge this year, and that's why bank stocks are doing so well.
And then there's the backdrop of the demand, right, Dick? I mean, if you're getting better demand, you're going to have people spending more money, also a positive for the banks. What about the backdrop? What kind of a macro story are you expecting for 2021, Dick?
Well, I mean, we've got to get people, as you said, Maria, we've got to get people spending money. We've got to get companies investing in, capital projects, in inventories and receivables. And the problem that we're having at the current time is neither one are doing that to a very great degree. In other words, we're in some type of liquidity trap where the money is there, but it's not being utilized. People have bigger deposits in their bank accounts right now than they did a year ago. So the net effect is that money's got to come out of these bank accounts. It's got to come into the economy. And my guess is with $1.9 trillion in stimulus, that will happen. And if that happens, we'll utilize the excess cash. We'll put it to work. The economy will do better. The banks will make a lot of money, and everybody will be happy.
Yeah, and John, what do you see in terms of this stimulus and the macro story? How does that play into this reallocation that you referred to earlier? Are there areas of this economy, John, that you see growing more so than other areas?
Well, I'll tell you, we believe clearly in the scenario that Dick just laid out. We see the economy getting back onto a virtuous cycle where the consumers right now and investors have a tremendous amount of liquidity. Hopefully that liquidity, hopefully that stimulus gets consumer confidence up. We're going to have the vaccine is rollout is going very well. So you see increased consumer confidence. What we're hoping is that flows through to businesses. They start to increase capital spending as they see their businesses increasing, and not just a blip, but they're seeing it increase on a sustainable basis. So that's one of the reasons why we want to be exposed to this cyclical cycle. We see us getting back onto a virtuous cycle and not so much just a sugar rush where you see stimulus come out and then the economy fades. We think we're going to get onto that virtuous cycle. Therefore, to follow on with what Dick said, we like the regional banks. You know, and we like them even more than the money centers because they're more exposed to that tremendous jump that we've seen in the yield curve. They're a net interest margin bag, and we want to see the regional banks do well, even better than the money centers.
And real quick, do either of you see inflation or higher taxes cutting into any of this positive macro story later on in the year?
Yeah, I'm a very big believer that inflation has already begun and that by next year we'll be in a 1970s situation where it'll be out of control. And therefore, that will add to the earnings in the banking system, but it will cause problems with the price earnings multiples on common stocks. But at the moment, I think that the Fed has no choice. It must buy all of the debt that is not purchased by others. In other words, if we run a huge deficit, the Fed will be the buyer of last resort of that debt. And when they do that, they increase money supply extraordinarily rapidly. In the last 2 years, the money supply of the United States has grown 10 times faster than the economy. What they call, called the velocity of money, but a couple of years ago.
Yeah.
Well,
yep,
I
totally see that. Yep. Go ahead, Dick.
All right. Well, as I say, a few years ago, $1 of money bought you $1.80 to $2 of GDP. Right now, $1 of money creation buys you $1.13 of GDP. So the net effect is money is not working to grow the economy. The Fed is actually doing a lot, but it's not helping the economy by printing money to buy debt. And I think that's extraordinarily inflationary. And I think that's going to be a huge problem in 2022.
And so many unintended consequences when you have all of this free money, for sure. Dick Bove, John Traynor, great conversation. Please come back soon. We'll keep following it and have you back to discuss. Thank you, gentlemen.